Hi, I'm Vishnu Srinivas, and welcome to Hawkeye. I started this podcast to give professionals an open platform to share their candid views on topics impacting businesses and economies around the world. Make sure to rate, review, and subscribe.
Joining me today is Jim Bianco. He is the president and founder of Bianco Research. Thanks so much for taking the time to speak with me today.
Yeah, thanks for having me.
Awesome. So do you want to start off with an introduction about your background and your role?
Yeah, so I am, as you mentioned, the president and founder of Bianco Research. The firm was founded in April of '98, so we just had our 24th anniversary. We produce investment research primarily designed in the macro fixed income space for institutional investors. We are affiliated with a brokerage firm in Chicago called Arbor Research and Trading. They serve many roles, own part of my firm, I own part of them as well too. As a independent research firm, we have the ability to kind of do whatever we think is interesting. And I'm not beholden to any voice as to what I can or cannot say in terms of conflict of interest. Obviously, I don't want to say things reckless or irresponsible, but I have no conflicts of interest on what I say about particular views on the marketplace. That is kind of the short answer for where I am. We produce research behind a paywall for paying clients, and a lot of people know me because of my presence on social media like LinkedIn and Twitter.
Awesome. Yeah. So let's kind of get into a bit about like the work that you do. Obviously, it's in macro strategies. So starting off, like what goes into developing your macro strategy process that like makes it unique?
I think that anybody who does this macro space or macro thing like I do, he has to develop a philosophy on how they view the world. My philosophy, how I viewed the world before I started Bianco Research, in fact, 10 years before I started Bianco Research in 1988, I got my Chartered Market Technicians affiliation with the Market Technicians Association, as it was called then. It's the CMT Association today. I actually worked as the assistant to the technical analyst at First Boston, which is the pre-runner of Credit Suisse, a guy named the name of Joe Generalis, and was with him also when we went to UBS Phillips Drew, for those of you old enough to remember that name, which is now just UBS, in 1990. So coming into this space, I came into it with a bent like a technical analyst. I was big into looking at patterns, at flows, at a lot of other things that are tended to be more chart visually based. And to this day, a lot of those philosophies still come through in my macro research as well. Now, it's obviously expanded beyond that. But at heart, if you put me under truth serum, and you would ask me, am I an economist? I'd say no. Am I a technical analyst? I'd say yes. So I kind of take that approach to it and always have.
Yeah, I think it's an important distinction to make. So going deeper in that, I guess in your time in macro strategy, what have you found to be the biggest challenges that the field presents?
There's a couple of them. I think the biggest challenge when I first started in the field in the 90s was the whole idea of, why do I need a macro analyst? Why do I need a macro opinion? I need a ticker. What stock should I buy? What good is it if you tell me about these big macro overarching themes? Okay. Fast forward a decade or two, and now we've got more ETFs than we have stocks. So if you have a theme about the dollar or about commodities or about inflation or the growth of the economy or the political outlook, there's a ticker for you out there in terms of an ETF or some kind of passively based ETF in order to express that bet. So the macro space really has come from there to here. The other thing is, I'll come back to what I said before, a philosophy. My philosophy is a little different. I think a lot of macro people really come to it as either international strategists, and so their orientation is the dollar currency and Forex exchange rates. They start with that. I don't usually. Or they were an economist, and they usually start with what is the growth rate of the economy. I do look at those. Obviously, I spend time expressing ideas on that, but that's not my nexus. My nexus is more in flows and in patterns and in the things that you would most associate with being a technical analyst.
Yeah, I think those are really good points you brought up. And you also talked about a lot of issues that we'll get into later in this episode. But starting off with, we have to talk about inflation because it's just been the talk of the town for like God knows how long.
A year.
Yeah, definitely.
Yeah.
But just to start off, like, do you think the Fed has a target number or metric in mind they're going for? Because just to give us some idea of like where this is heading.
Yeah, they're panicking and they want it lower. That's basically what their target is. Just make number, to use a crypto comment, number go down is what they really want with inflation. They have a target. That target on inflation is 2%. That had been developed by the Fed in 2012 under Ben Bernanke. That's when they officially rolled it out. They talked about it for many years before that.
Right.
And it worked fine. Sort of kind of worked fine between 2012 and 2020. Their biggest problem then was that that inflation was consistently coming in below their target. But post-COVID, post-reopening of the economy, or post-pandemic, as I like to call it, it's been way above. And it has astonished everybody. Look, I was an inflationist, and a lot of people give me credit for being one of the first people to worry about inflation. I thought it was going to go to 4 or 4.5. It went to 9. So it really, it shocked everybody at that point. The thing that I've been most disappointed with in the Fed is, like I said, it's very apparent they just want number go down. They want it to go back to 2%. But I would like them to give us some explanation as to why it went up. And why do they still think that 2% target from pre-pandemic days is still applicable from here going forward? They don't really address that. They leave that kind of assumed, but never stated outright. The biggest disappointment was last week was the Jackson Hole meeting. Every year, the Fed has this big confab in Jackson Hole, Wyoming. It is nominally an academic conference. So there'll be some economists from the University of Michigan there, but there won't be any economists from Wall Street there. And so it's supposed to be where they talk about big picture ideas. And all the presentations were about big picture ideas. And they were about, inflation. But the chairman himself, when he gave his speech, it was only 8 minutes long. And you could basically sum it up as, when we're done raising rates later this year or early next year, we're not going to cut rates next year. Okay, that's a short-term tactical thing, Jay. But why don't you talk about the big picture? Why is inflation at 8.5?
Yeah.
And why do you think it's still going to 2? The reason I don't think they did is I don't think they have an agreement as to why that is. Or some in the Fed think that 2% is still applicable, and I think others in the Fed don't. And since they don't have an agreement on it, that's why it wasn't addressed.
Right. Yeah. And like, not to turn this into like a Fed bashing thing, but I think we have like a right to question like some of the decision-making process and like what goes into it. So as you touched upon, like it's kind of been distilled down to like a oversimplified like number go down. Do you think they can achieve this by simply just continuing to hike interest rates, or do you think they have to get creative and think outside the box?
Well, yeah, 2 ways to answer that question. Yes, they could wreck the economy and they could kill demand and they can get inflation down. Congratulations, you got to your target. Putting a suicide vest on the economy is not the way you want to do it. But they could get creative and they could look at other ways of trying to bring inflation down. But what that requires is what I just talked about a second ago. Where do you think it is? If you ultimately believe that inflation will return to 2% in the next year or two, you don't have to do anything. It will just go there by itself. But if you don't believe it's going to be 2%, then you have to answer the question as to why do you think it's higher and what can be done about it? Now, I've got my theories as to where it is. I mean, real quick, I don't believe that inflation is going to go back to 2%. I think it's going to level out at something like 4, 3.5, maybe 4.5, somewhere in that range.
Mm-hmm.
The reason I think that is the three things that kept inflation pre-pandemic low was cheap labor through immigration. So we kept getting ever cheap labor, and I kept undercutting that, and also globalization. If I couldn't cut my costs by getting cheap labor through immigration in the United States, I would ship my jobs to China, Vietnam, Indonesia, take your pick. That kept wages stagnant. Why didn't the populace revolt over stagnant wages? Because the second thing we gave them was cheap goods. China being the factory of the world, everything at Walmart got ever and ever cheaper. So yeah, you weren't getting a raise, but nothing was getting more expensive either. And the third thing is, what else did we have? Especially, this really applies for Europe, was cheap energy from Russia. So they had cheap natural gas and everything. Russia is the largest oil producer in the world, even larger than Saudi Arabia. And they helped to keep all of that down. That helped to keep the inflation rate under 2%, not only for the decade of the 2010s, but probably a decade or two before that.
Mm-hmm.
But now I think all three of those things are being questioned. Cheap labor and globalization is leading away to reshoring and higher labor costs. Cheap goods from China. China, first of all, their economy, because of their zero COVID policy, is a mess.
Yeah.
They keep locking down. They just locked down another city of 21 million 2 days ago. So you can't trust them. And there's also a lot of political strife with China. And cheap gas or cheap energy from Russia, that's out the window since the war with the Ukraine. So all of the things that kept inflation down are reversing. I think that that's why the inflation rate is going to stay higher until we recognize they've reversed and we need to restructure the economy for this new reality. Now, a lot of people have used as the example the late 1940s. After World War II, the economy went through an epic change.
Mm-hmm.
The big difference, and there was recessions and inflation too, but the big difference was in 1947, everybody knew that the war ended. No one in 1947 was saying, when am I going to get my job back making Sherman tanks and fighter planes? But in 2022, there's a fair number of people that will listen to what I've just said and say, no, nothing's changed. You just wait. Everybody's going to go back to the office. Work from home is going to stop being a thing. We'll keep getting cheap stuff from China. Globalization hasn't stopped. And eventually, when everything settles down, Russia has no choice but to send us cheap energy forever and ever. And so we still debate this issue. Now, maybe I'm wrong. That's fine. But we need to have this discussion. And ultimately, the longer we make this off, if I'm right, and that what we need to do is restructure for a post-pandemic, post-globalization economy, we're not doing it. We're just having an argument whether or not it actually takes place. So we're taking more and more time. And until we do, frictions, market volatility, higher inflation will be the order of the day.
Yeah, I think you just touched on it, but just like get it, like flesh it out even more. You see recession and inflation as problems that are here to stay for the future, right? Like I don't think like we should just have this, quixotic view that like, oh, we're rebounding, we're going to get better, until like we actually see some evidence of positive change.
Yes. So pre-pandemic, you had 10 years of economic expansion, 2009 to 2020. Before that, you went 2001 to 2008. That was a 7-year expansion. And before that, you went 1991 to 2001, 10 years. So, from 1991 to 2020, you would have a recession about every 7 to 10 years. Mm-hmm. We are now currently a little more than 2 years past the recovery that began in April of 2020.
Right.
And there's an argument to be made, I happen to be in this camp, that we're already in recession because we had negative GDP in the first and second quarter.
Yeah.
So it was only 2 years. I mean, it's a debatable proposition. I mean, I'm of the camp that we are having a recession, but it's very mild right now. Mm-hmm. It could turn into something more. We'll see. But it's only 2 years. That's my bigger point. So these cycles now are becoming much faster than we've seen in the past. And that is part of this friction and this change in the economy. We're no longer in a low economic volatility world where, yeah, well, we'll just keep recovering for another 8 more years before we have to worry about a recession, because things are changing. The economic volatility is very high. That's why the inflation rate shot up to 9%. And maybe, we'll see where it goes now. And that's why after only 2 years of recovery, we start printing negative GDP.
Yeah, exactly. And like, not to make this like kind of a we're oversimplifying like the definition of recession, but like then 2 negative quarters GDP is still like a poignant like metric for it, even if like you don't live and die by it.
Well,
Shifting
let me
gears-
give you let me give you the history on that so you can understand where I'm at.
yeah,
Macroeconomics was really developed in the 1920s as when it became very, very popular. And at that time, they used to call a downturn in the economy a panic. The Panic of 1871, the Panic 1892, the Panic of 1907. In the 1930s, when the economy was turning down, the Hoover administration didn't like the word panic. So the wordsmiths came up with a gentler word, depression. And so they called it a depression. Well, in the 1970s, when the economy was turning down, we were wondering whether or not we were going to have another depression in the 1970s. Well, the Carter administration didn't like that word. So the wordsmiths came up with another euphemism called recession. And famously in the 1970s, there was a very famous economist, Alfred Kahn, who lambasted the whole idea because he gave a speech and he talked about, I'm just going to call it a banana. And he said, I do believe we're going to have a banana, is what he did. Well, today, the Biden administration doesn't like the word recession. So they're like trying to find another word for it, contraction, downturn, whatever word we come up with. So whether it's a panic, a depression, a recession, a downturn, it's all the same thing is what it is. It's just that, Wall Street can't, we're not going to have a recession because what a recession means is calamity. Well, we're not having a calamity. No, a recession means downtick. And that's what happened. We downticked. But I know it's a highly charged word. I'm sure that there are people that heard me say, oh yeah, I think we're in a recession, winced, because it just doesn't mean that some economic statistics downturn. It means people lose their jobs and they protest and it's ugly and terrible and all these other things. Well, it can be that, but I just think it's all part of the same thing. It's just a downturn in the economy.
yeah, whatever you call it, we're living it. And it's not inflation and like recession, like a -2 quarters negative GDP and like 2%. Like these aren't just like numbers like that are like separated from the real world, like actually affect people's pocketbooks, like everyday living, like and like other kind of facets of everyday life. So it's important to keep that in mind. Let's quickly shift gears to how this could impact investors in the economy, because obviously we're seeing persisting yield curve inversion in addition to these higher interest rates over these past few months. How do you see this affecting investor activity? And I guess break down like how these are playing out so far, these different metrics.
Well, on investor activity, I think the first thing that you need to understand, and this is really hard for investors to get their head around, and I'll say it and it'll sound controversial. The economy doesn't matter. What matters is inflation. Yeah. So everybody gets, whenever people ask me about the economy, are we going to have unemployment or what's going to be the growth rate? And, how's the Fed going to respond to all of that? And whenever I shock them, I say, none of that matters. What matters is the inflation rate.
Yeah.
And whether or not the inflation rate goes up or down. The Fed is focused on the inflation rate. They need to get that down. If there's a byproduct of higher unemployment or a recession or economic volatility, that's the byproduct. So let's start with the focus is on inflation. Now, why is the focus on inflation? Because it's been 40 years since we've seen inflation. So, unless you're in your 60s, you're not going to remember it to any great degree. And the reason that inflation matters is it impacts every single person in the country.
Yep.
Elon Musk feels inflation. He sees it in SpaceX and Tesla. People on public assistance, they get impacted by inflation as well. And Jay Powell is correct to say the bottom 40% of the population, these are people who have a job, they don't own their homes, they don't have a stock portfolio, so they don't even own any assets.
Yeah.
They just get killed by inflation. Everything costs more, but their paycheck is not going up fast enough to cover it. The rest of us, if you remember last year, I know this year the markets have been troubled, but last year the stock market was up 29%. The Case-Shiller House Index was up 18%. All right, I see inflation too, but my house is going up, and my perceived net worth is expanding so I could survive it. But if you're not you're in that bracket, you're in the lower bracket, you don't own a home and you don't have a portfolio, you're being hurt quite a bit by it. So the point is, I understand where the Fed is coming from. And I think they're right to say inflation impacts everybody. Unemployment, a downturn, those things impact a small percentage of the population, but it could be devastating for the people it does impact, because when you lose your job, that's a big deal. But it doesn't impact everybody. So we cannot dismiss inflation. Now, unfortunately, a lot of people do. Well, it's inflation. Yeah, because you have $1 million portfolio, you drive a Mercedes, and you had a big house, and it's all going up in value. And so you're doing okay just by existing. But people that are in the lower end, they're not. So I do think the first thing is we have to understand the center of the universe is inflation. It is not economic growth. It was for 40 years, but now it's inflation. To that end, to deal with the inflation scenario is going to mean a lot of economic volatility, which is going to translate into market volatility, with markets gyrating around all over the place. A lot of people would then say to me, yes, I understand that inflation is a big problem. I agree with you, but in the phraseology that they'll use is the Fed can't print container ships, or the Fed can't print oil, or the Fed can't print, more jobs. They can only print more money. It's like, but what that is suggesting is the problem is on the supply side. There's constraints on the economy on the supply side that won't let it expand.
Yeah,
that's actually true.
Yes.
And I might add that every inflation ever has always had supply side constraints. But there's also a demand component to this too. Excess money, excess demand. The New York Fed and the San Francisco Fed have both done studies looking at the inflation rate and have come to the conclusion we have more excess demand in our economy than any other developed economy in the world, and that over half the inflation rate is probably due to excess demand. The money we mailed out in pandemic checks, the stimulus that we've been doing, college loans being cut, and everything else, all that stuff adds up into throwing money at everybody. And what you're basically saying is, I know the prices are so high, here's some money to cushion it, then the prices are going to go even higher. And so the Fed is correct in saying that a part of this inflation problem is a demand side problem. You can bring down the inflation rate a lot. The supply side will take time. It will take a recognition that cheap jobs, cheap goods, and cheap energy is gone, and we need to restructure the economy. Then we'll fix the supply side. But there is a demand side component that's keeping inflation up. And the more that we say, no, the Fed can't do this because the stock market might go down or something else, the more we consign people that shop at Dollar Tree and have slower incomes, maybe just above minimum wage, to more destitution because they cannot keep up. And so that's why inflation is such a terrible scourge. Fortunately, it's been so long, a lot of us just forgot how bad it was.
Yeah, definitely. And I think the demand side is really important because, ever since the COVID pandemic hit, if any metrics you look at, it's been an unprecedented catch up in demand, I guess, and it's just been so much excess demand. And I feel like a lot of people are having this debate over supply or demand being responsible for inflation, when we should just recognize that it's both factors and
not only is it both, it's always both.
Yeah,
it's always both, to varying degrees. It's rare that it's 100% one of those and zero the other.
Exactly.
It might be 40-60 or 60-40, but if you've got excess inflation and you could get rid of 40% of the inflation with demand, reining in demand, then you would do it. The other thing you asked me about too, as long as I'm there, is about the yield curve. A quick word about the yield curve. That's the difference between short rates and long rates.
Yep.
And normally the yield curve, as you go further out in time, a bond that matures in 5 years or 7 years or 10 years or 30 years, you take on more and more risk because the future is uncertain, and 30 years is more uncertain than 5 years. Right. And so in a normally sloped yield curve, interest rates should be higher further out the yield curve, expressing that there's more risk there. But now the yield curve is inverted, where short-term interest rates, the 2-year yield, is higher than the 10-year yield. What is going on there? Well, two things. On the front end of the yield curve, that reflects the belief of Federal Reserve policy, because the Fed sets short-term interest rates, and things like the 2-year are heavily influenced by it.
Yeah.
The perception here is we've got an inflation problem. The Fed's raising rates, is going to raise rates again later this month. It's going to raise rates again in November. So the 2-year note yield is up because the Fed's raising rates based on inflation. The back end of the yield curve, the 10-year note, what usually drives that is perceptions of economic growth. If the economy is weak, we're having a recession, those rates will relatively stay down. If not, if perception is the economy is strong, those rates will relatively go higher. Well, the economy is perceived to be weak. The fear is that we might be inducing a recession. So relatively speaking, the 10-year yield, even though it's been rising, it's been rising less than the front end. And that's why the yield curve is inverted. So what is it that it's telling us? The Fed's going to keep being aggressive. That's why short rates are above long rates. And the reason long rates are not going up above short rates is because the fear that the economy is going to slow. And the last thing about the yield curve, it has almost an unblemished record of predicting recessions. It's 8 for 8. We've had 8 recessions since the mid-1960s. And every time the yield curve is inverted, it has led a subsequent recession. So it's one of these few indicators that has a perfect track record. Maybe it's different now because it's post-COVID. The Fed's doing QE, QT, quantitative easing, quantitative tightening. They're messing around in markets more than ever. And the beauty about the yield curve was supposed to be a market-based measure of what they think's going on. Maybe that's messed it up. We'll see over the next year or two. But its historical track record's unblemished.
Yeah, chalk that up as another piece of evidence that we're definitely in a recession. But let's go back to like the implications on investors. I mean, it kind of feels like a lose-lose situation then with this yield curve activity and obviously the persisting inflation. Do you think, like, should investors be more risk averse at this time? How do they kind of navigate this?
Yeah, so it is. If you look at markets, go back to the beginning, I'm a macro guy, right?
Yeah.
And one of the big things everybody asks me is, as a macro guy, is what do I do with my money? And what that means in the macro space is stocks, bonds, international, emerging, something is going to go up in that space. One of those big, huge asset classes. Which one? And from 1981, 41 years ago, through this year, with 2 brief examples of one in 2008 and one in 1994, every single half-year increment, I'll go in half-year increments, you always had something go up. The stock market, U.S. stocks or international stocks or emerging stocks, or U.S. bonds or international bonds or emerging bonds, one of those went up and made you money. This year, not only did all of them go down, all of them went down a lot. And that in the history of good statistics, I can't find another 6-month period that everything lost you money.
Yeah.
Basically, now you could get cute and say, well, what about commodities? Or what if I invested in crude oil? Yeah, you could define asset classes to the nth degree. You could go out into infinity and defining them. But if you stick with the basics, international, domestic, emerging, stocks and bonds, those 6 major categories, only 2 periods, 94 and 08, did none of them go up. And in that case, the best performer was still like minus 1%. But in the first 6 months of this year, the best performer was minus 9%.
Yeah.
So basically, if you're an investor, you're losing money. You're losing money unless you're investing in singular specific ideas, idiosyncratic ideas.
Yeah.
You're losing money across the board. So this has been painful for investors in an unprecedented way. There's no large place to hide. Again, you could argue commodities or energy. If you keep redefining asset classes, if I keep going long enough, I can redefine it as Tesla as an asset class and eventually find a stock that went up or something like that. But yeah, so that is the first thing to understand, is that this has been unmitigated hell for investors because there's nowhere to go. And that is because of what inflation does. It makes the purchasing power of your dollar lose. Everything loses, and that's what's happened. So I think for investors, you cannot overstate this inflation story. This should suck up all the oxygen in the room, because until it gets solved, and it won't be here forever, but it still might be here for a couple of more years.
Yeah.
Until it gets solved, it's going to dominate everything. So I think investors are going to have a very, very difficult time. Probably the safest place to be are things like cash, or maybe if you want to, go off into the alternative in asset class like commodities. But the problem with commodities is their volatility is as high as Bitcoin. So yeah, buy commodities, you'll last 15% in 2 days. That's Tuesday. That's just the way they are right now. They're so volatile. But if that volatility is too much for you, hell, you might as well buy Bitcoin at that point. If that volatility is too much for you, then maybe cash and just getting your 2.5% might be the best place.
Yeah, I think it's really important to hammer that point home that, everything is coming back to this issue of inflation, which is why we're making such a huge deal about it. And it's really hard to avoid just the systematic risk that almost every investment is facing in this market. But let's give some investors a bit of hope, to end this out. I guess we've been seeing, strong dollar activity against other currencies, namely the euro. Do you think that could emerge as a new safe haven, and maybe the reasons behind that, do you think is a sign of strength of the U.S. economy, or just it's not being crushed as hard as internationally?
Yeah. So two things I'm giving people hope here. First of all, you're right that the strength of the U.S. dollar, the dollar is the reserve currency. And in periods of stress, and we saw this in 2020, and I'll use a technical term here on you, when the shit hits the fan and no one knows what's going on, first thing is run into the dollar. Well, for Americans, we're already in the dollar, but for foreigners, it means get your money in dollars. And so what happens when things get unstable, like 2020 and now, is you see a big dollar rally. We could jump and yell about the state of the American economy or our politics or whatever you want, but investors pretty much told you what they think of the U.S. economy. Foreign investors, they think it's the safest place to be, which is why our currency is going up. The second thing I would leave you with in terms of hope is I happen to think we are in the process of changing the economy from this globalization, cheap goods from China, cheap energy from Russia.
Yeah.
We need to restructure. What that means is we need to change where we get our cheap labor. We need to change where we get our cheap goods. And maybe that is in the United States, or maybe it's somewhere that's more politically aligned with us that causes less political problems. And we need to find alternate sources of cheap energy. There's a lot of investment that needs to be done on that. That is the opportunity for investors. But if the answer is, when is it just going to go back to the way it was before, where everything just went up and the Fed printed money and I complained because I was only up 28%, not 30%, and even my bad stocks were up 12%, my good stocks were up 40%, that era is over. That era is over right now. That cheap money, everything goes up era is over. This is a different era. Different era means there will be opportunities. It just won't be the same ones that we saw in 2019. They'll be much, much different this way around. So as we start to understand the economy's changing, as we start to understand that we need to do different things, there will be opportunities that will come aboard. Look, you saw this early in 2020 when everybody was sent at home. You initially saw this enormous rise in like the Zooms and the Pelotons of the world, the work, and they gave them a term, the work from home stocks. Now those stocks got overdone, they peaked and they came down. But what that was investors saying something's changed here and we have to run to the new thing. I think that's what we need to start thinking about is something is changing in this economy and we need to figure out what it is and we need to run to the new thing. And right now, I'm going to tell you, I'm not sure what it is other than maybe value stocks, maybe some construction stocks, maybe some energy stocks, along those lines on the change of where we're going to go. growth, the old growth stocks that we all loved, you know, the ARC, unprofitable tech stocks,
Yeah.
those are going to struggle as we move forward from here over time. They have been, and I think that they are still going to, as we try and sort out what this new economy is. What I was going to say was, I'm not sure what it is that this new economy is, but I do know it's not 2019. And what I've been railing about most is I hear all my friends on Wall Street say, well, when things return to normal. No, this is normal.
Yeah.
This is normal. Enjoy it. That we're not going back to 2019. As we record right before Labor Day, Wall Street is making another big push. JP Morgan, Goldman Sachs, Jefferies, Morgan Stanley. Everybody's got to get back to the office after Labor Day. Okay, this is like the fourth time in a year they've tried this. And basically what happens is no one goes back.
Yeah.
And they almost dare you to fire them. Let's see if this one works. If this one doesn't work, I'm of the camp that this work from home thing is the biggest thing that happened in the labor market in many, many decades. It's changing the nature of work, the nature of the office, the nature of how we live our lives. It's changing our consumption baskets. We consume more things, less stuff. The retailers are really struggling with this. That's why they've got bloated inventories. A lot of people say, well, they got bloated inventories because the economy's turning down and no one can spend any money on anything. That's somewhat true. I mean, it's not untrue.
Yeah.
But also, when the economy was reopening, they stocked the shelves with the same stuff in the same proportions that they had in 2019. And what did they find out? When we go to the store, we don't buy the same things in the same proportions as 2019. It's a different economy. So the retailers are finally starting to sit down and go, what is it that people want in 2022? And what proportions do they want it in so we could stock the shelves correctly? And by the way, the answer is not what they bought in 2019. And so there's a number, like I said earlier, there's a number of people that still think 2019. Dave Solomon, the chairman and CEO of Goldman Sachs, has said, you watch 2024, 2025, Midtown Manhattan will look just like it did in 2019. Today, if you go to Midtown Manhattan, it looks like it looked on a Saturday in 2019. There's people there and there's some activity there, but it's not what it was pre-pandemic. I think he's wrong. I think this is a new era and they're hearkening for the old era to return, and change is hard. And change is not very clear as to what you're supposed to do with it. But yet I think that that's exactly where we're going. And that's the opportunity for investors to think about where is the change in the economy, instead of complaining about when's it going to go back to the good old days that the Fed is just going to print my portfolio into riches.
Yeah, I think the bottom line is that people just need to take off the rose-colored glasses, and the work from home dynamic is really something to keep an eye on, because I think that is pretty self-explanatory in terms of where we're heading and where we can't return. Awesome stuff. Jim Bianco, thanks so much for taking the time to speak with me. I really appreciate it.
Thank you.
I hope you enjoyed that. For more content, check out the rest of the videos on my channel. And be sure to look out every Thursday for a new episode.